Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Quincy Krosby, chief global strategist at LPL Financial, to discuss how former chair of the Federal Reserve Paul Volcker would have reacted into today's inflationary environment and Fed interest rate policy. Quincy, this is a fantastic piece that you put out yesterday, and I just want to get some more background on Paul Volcker. We do reference him a lot, but he really, when he came out with all punches when he was fighting inflation.
Oh, absolutely, Jill. I mean, the unions were declining when he took over. He took over in 1979. They were a little bit in decline. Let me put it this way. He was their arch enemy, their arch nemesis, because he did not care about labor. All he cared about was bringing down inflation, and it was much higher and much stickier than it is right now.
I mean, he took interest rates up to 20%, if memory serves me correctly.
Oh, Jill, absolutely. In fact, August of 1982, we had actually one of his first rate cuts. The unemployment rate was still over 10%. Imagine.
Yeah. And then when that also set up for one of the, biggest bull market runs of all time once he started to cut the rates in August.
Absolutely. It was what we call a secular bull market. It was meaning there was something important that changed the backdrop, which was that he was starting to cut rates. And we also had, a favorable tax backdrop. But keep in mind, he was despised then by labor, despised now. However, economists from all over the world treated him as if he had come from above, because what they learned was that via monetary policy, you could make important change. In this case, you could bring inflation down via monetary policy.
So we have Jackson
That was a change.
Right. And of course, we have Jackson Hole this week, right? And that's where, with the exception of NVIDIA coming out after the close today, that's where investors and traders are going to be focusing their attention. Are there any similarities for what Powell is dealing with now versus what Volcker did? Or is it just, is it relative? Is it on a different scale?
Well, it's obviously not as much inflation. However, one of the things that Powell has to deal with are higher wages. And in addition to that, look at all of the deals that have been struck with pilots, with UPS, for example, American, I could go on, where they're all going to have higher wages and better benefits. That is something that Paul Volcker would say, you know what? I understand that there's a mandate to create an environment of sustainable economic growth, which is the labor mandate. Don't pay attention to that. That's what Paul Volcker would say, because he said, if you pay attention to that and say, gee, this is great, we can't do anything to hurt labor. His point was, you're going to bring back inflation, and you're also going to weaken the US dollar. He had majorly contempt, actually, for that particular mandate, because the Fed is dual mandate. However, it's a different time. Powell does agree with it. I think in his heart he agrees with it, but it's different this time. The doves at the Fed are saying, look, let's just go on a long pause. Let the lagged effects come in. The cumulative effects of the rate hikes will bring demand down. Paul Volcker would never stand for that. Paul Volcker would say, go in now and go in and raise rates, because the 1970s, and Chairman Powell has mentioned it over and over again, it was a failed policy of raising rates, stopping raising rates again. It brought inflation back, but it brought stagflation back, which is probably the most insidious backdrop for an economy and a stock market. You're basically killing both.
So this might be a rhetorical question, but what do you think Paul Volcker would say this week, right? You have the 10-year continuing to edge higher, but he just seems to be, or Volcker would have been, resolute in getting past this last mile of getting inflation under control.
He absolutely would be. And again, Powell has difficulty because he doesn't necessarily rule the way Volcker ruled. Volcker ruled the way Greenspan ruled. He did what he thought he had to do. You didn't have these meetings. You didn't have every meeting live. You didn't even know what they were doing. You didn't even know when he cut rates. It was sought out by a very famous economist at Solomon Brothers, who went out in the fax machine and said, get into the market right now. It was quiet. It was held quietly. Powell is, again, being criticized over and over again for not accepting higher wages. Remember, you'll hear people say, what's wrong with higher wages? These are low wage earners who, for the first time, are getting higher wages. He has tried to say, well, guess what? They're also paying more for their credit card. They're paying more because of inflation. We need to have a healthy labor market. That means price stability. So he says that. The question is whether or not he'll be able to stick with it. Last year, he was absolutely Paul Volcker. It was straight out of the Paul Volcker um, autobiography, actually, of Paul Volcker. He talked like Paul Volcker. He sounded it, and boy, did the market get the memo.
You know, it's so interesting, Quincy, that you bring up you had to get messages across through the fax machine. I also think part of the composure of the market is different these days as well, because the mode of communication is just so much faster. I don't remember retail market participants even paying attention to what happened with rates as much as we are now. I mean, we've been laser focused on this for at least the past 5 to 10 years. And to your point, I think it's because these are communicated faster. It doesn't even have time for policy to work its way through the economy or the markets.
Well, exactly. I mean, the hawks at the FOMC, Federal Open Market Committee, their view is, look, we do move faster. Financial conditions do the job for the Fed. They have tightened, and the news is out there. So therefore, this lagged effect that takes about 15 months may not be as prominent now as it was back years ago, without any news coming, forthright news coming from the Federal Reserve.
All right, Quincy, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.